All right, here I am with Nick Hodge and Tavi Costa. It's great to see both of you. Thanks for making the time, and I'm looking forward to chatting.
Pleasure to be here.
Same, Jay. Thanks for having me.
Yeah, no, pleasure's all mine. I'll start with you, Nick. Give me a high level right now. What macro themes are you most focused on right now? There's like threads in every direction. It seems to me, no matter which direction you look, chaos abounds. And so how are you sifting through this noise? Like, what are you paying the most attention to right now? What's the signal that's catching your attention?
Chaos abounds for sure. You could run in all sorts of different directions. I think trying to separate the noise from the signal and finding one or two things to focus on for me in a word is stagflation. I think is where we're at. We've got these rates that now people are realizing are going to be higher for longer, a theme that I've been saying for a year, and you've got relatively subdued growth in the US and elsewhere, Europe, et cetera. So here we are, we're chatting in October. I think you're going to get a Q3 GDP that shows growth, not contraction. But then I think in Q4 of this year and then headed into next year, we get back to sort of that slowing growth recession narrative. And you're right, there's a ton of other things we can point to that hint that that's coming, whether it's the consumer or the yield curve, et cetera. But to keep it concise, I'm watching growth and inflation. And for me, that's translating into stagflation.
Okay, I want to pull on that in a minute here. But you made the comment about rates staying higher for longer. It wasn't that long ago that the conversation was more surrounding when will the Fed pivot, almost like that was the guarantee. And the question was, how soon will that occur? And I've seen a shift in conversation in just like the last 2-3 months where that conversation's decreased a lot in terms of volume. And I'm hearing more and more people speak about the higher for longer narrative. And I had Jim Grant on my program, who's kind of the rates guy. And he steps back from this and says, people misinterpret, the volatility of rate cycles. If you look at long-term trends, rates move generationally. You sort of see a long-term secular uptrend from like 1940 to 1980 and a long-term secular downtrend from 1980 to 2020. And we're now pivoting to the next generational shift. Tavi, what do you want to share on that in terms of your perspective on the higher for longer Fed pivot? How are you interpreting that noise right now?
Well, I think the Federal Reserve has a issue at the core of their responsibility for the U.S., which is essentially falling demand of U.S. Treasuries, which I don't think we've faced this in probably ever since the existence of even in the World War II and World War I. There was a significant level of demand for Treasuries coming from households, and that creates some real issues. I am quite worried about the fact that we were seeing this value destruction of collateral price of fixed income all over the world. TLT, who would have thought it's down like 50%? You look at microcap equities, they're down 40% from their highs. Russell 2000 small caps, they're down 30%. That speaks volumes about the health of the economy, but also, what else is going to break here? I've been thinking about that question a lot, and I have some thoughts about it. I think if you can find a source of volatility that is cheap, you want to be long that. And I think there's a few pockets of that in the markets. I think volatility could be a lot higher than what it is currently. There's 3 pockets in my view. One, the FX market. I think we're back to the old days of macro when George Soros and other macro funds used to make significant amounts of money on depegging of currencies and other things. And this is mostly due to a higher interest rate environment that creates also pressure on even the valuation of balance sheets of central banks and other things. And, who is selling those treasuries right now, causing this move that we've seen, I'm talking about in the last 1 or 2 months? Is it a central bank in trouble that is being forced out of the trade? Or is it just 60-40 portfolios, starting to change their mandates and things like that? Those are a lot of good questions. I don't think anybody knows the answer because most of the central bank numbers come out late. So we don't know who is really selling. Is it the BOJ? Is it, even the PBOC could be one of those. And so that's one source of it. I think the volatility in the dollar is still cheap in some parts of the market, particularly the companies or the countries that have pegged currencies. Number two, I would say credit spreads look really interesting. I don't think there's ever been a time when something breaks in the economy and you don't see credit spreads blowing out. So credit spreads certainly look like another way of hedging this exposure on the downside of the market. We haven't really seen, I mean, credit spreads so far are still sub 2%. That's historically low. Even in the high yield market, and again, that has to be hedged with the long trade on treasuries, which is not ideal. Don't get me wrong, it's hard to be structurally bullish on treasuries, but as a trade of that relative value of treasuries versus junk bonds, it looks quite attractive. In the third place, I think it's mega caps. I just can't believe that we're going to see cost of capital staying where it is, and that won't have an impact in the valuation of ultra long duration assets like mega caps. And so I think that's another source of cheaper volatility that I'm focused on. So those are the three things that comes to mind, along with this big issue that I'm being very concerned about, the treasury issuances and obviously the fiscal reckless that we're seeing in terms of spending. But and even the war now, two wars breaking out at once, or developing at once. So it is, where are we going to go? And defense spending, by the way, it's at one of the lowest levels in history. We haven't even seen defense spending increase to average levels. So if we see that, where are we going to be in terms of fiscal spending relative to GDP? So those are all important questions that I think Nick said well. I think rates are staying higher for longer, and how many bankruptcies we're going to see and other issues that potentially could be driven by this environment that is, I think, very troubling.
So pulling on your third point there, Nick, I want to go back to you. What do you make of the broad equities market right now? I think the S&P, for example, it's like 5 names presently make up about 24% of the entire market cap of the S&P 500, which to me appears to be like a one falls and we all fall scenario. And there's a ton of debt that will be repriced in 2024. I think something like $740 billion held by public companies in 2024, and another trillion in 2025. What's your take, Nick? Are you in the broad equities market right now? Are you keeping your distance? Are you seeing vulnerabilities? What's catching your eye?
We're in the broader markets, but defensively, and not long the S&P, not long the NASDAQ, for example. See more downside than upside in those major indices. And Tavi mentioned the Russell 2000. That was actually negative year to date a couple of weeks ago here in October, as was the Dow Jones. And Jay, you were talking about the weighted index of the S&P, talking about how it's being driven by 5 companies. Yeah, we've come to coin the term, the Magnificent Seven, talking about these big communications companies, the Metas and the Amazons of the world. If you take those out of the S&P, it's relatively flat for the year. I think last time I checked in early October, it was up 0.1 or 0.2%. And so a precarious place when you don't have that breadth. And I think it's a liquidity issue in one part. Tavi talks about how these mega caps can persist through a length of time or a duration of higher interest rates. And also they become liquidity stores unto themselves when you're talking about companies that have $1 trillion+ market caps, and you've got smaller cap equities that are negative for the year. They beget capital coming to them, especially at a time when you've got the 2-year yield at a 17-year high and has sort of demolished the 40% of the 60-40 portfolio. So not to tap dance around the answer, I think what I'm seeing is you had a pullback, right? You had this soft landing, Goldilocks narrative. You had stocks relatively strong throughout the year. August came, you had a spike in volatility. But what's going to happen here is you're going to see GDP that was positive for the third quarter. And so I've come to call it a double whammy recession, right? Or an eye of the storm, because you're going to see positive growth for this quarter. You've seen stocks go up. And if you recall, we did have 2 consecutive quarters of negative growth in the past year. I think you get back to that in the next, call it 2 to 3 quarters. I think I see a yield curve that's still inverted. That hasn't gone away. And I see a credit crisis that is likely going to return, at least as it relates to the smaller banks. I know these larger banks, JP Morgan and Bank of America, have reported earnings here recently, and they've been the beneficiaries as money has come out of these smaller banks. But you've got these 17-year high interest rates that are still going to be on the balance sheets of these regional banks, and that could be the next harbinger or event that people look to for a rise in volatility, I guess, is where I would end, which is something Tavi also mentioned. Yeah, you've had the volatility index suppressed here for the largely all year, as we've had a rise of these short-term dated options, these 0 days to expiration options that have come on and suppressed the VIX. You could see the VIX in the very real way get back above 20, like it was back in March when we had this regional banking volatility. At last check, I think it was down somewhere around 16 or 17. So short answer is no. I'm still defensive and long, at pockets of equities, a couple of defense stocks, a couple of consumer staples, for example.
And are either of you two seeing a shift in sentiment away from speculative growth stocks and towards the raw materials sector, the commodity sector? And I'm asking this because I'm seeing a surge in subscribers coming to my platform who don't have any experience in the commodity sector. And I rarely see this, but over the last 18 months, we've seen a big wave of generalist investors who are trying to understand the hard asset space, or the raw material space, I think is a better way to put it. Are either of you seeing that shift right now?
It's tough to say. And to a certain extent, it depends on the commodity, right? Like, I see a lot of generalists and what I would say, Twitter investors or retail investors flocking to the sectors that have been hot in the retail space, like uranium and lithium, for example. So, and I gauge this by, the seat of a publisher, not necessarily the seat of an investor. I'm gauging by interest rates and click-through rates and response rates. And so I can tell you, 100% sure that a uranium article gets more opens than a silver article, for example. And the same thing, a lithium article is going to get more opens than a copper article. And that's a function of the equities, I would say. Uranium equities have done fairly well. You've got a uranium price that's at a multi-year highs, trying to break out at $70. And same thing with lithium equities. I know they've been soft lately, but you've had some really salacious stories there with, stocks that have done really well, Sigma and Patriot and buyout wars in Australia, for example. And so that drives investor attention, whereas copper going down for the year from $4 to $3.60 doesn't necessarily, get people's hair standing up on the back of their necks.
Yeah, it's great that you're seeing surging members. I wish I was seeing surging prices of my assets, but they're not yet. So, but I would say the more people understand that potentially we are facing a secular inflationary problem, or at least inflation is staying higher than historical standards, I would say that it creates this sort of psychological environment in the markets where people start looking for pricing power, businesses that really protect themselves with pricing power. And there are many types of those companies that strategize in that manner. I would say that the commodity space has an inherent pricing power in their business, and majority of that has to do with the fact that hard assets tend to do very well in the inflationary period. So the underlying price of the commodity rises, and obviously they have pricing power in terms of that. And so it's not always that you want to be holding those types of assets, but certainly at a time when I would say majority of traditional investment strategies have completely under allocated for a very long time. And just look at, even you can see 60-40 portfolios popularity, but also even just the flows of CapEx between technology companies versus any resource industry. And that will show you very clearly how that flow has been very dislocated historically. I mean, for every dollar that comes into the global equity market, only 3 cents goes to metals and mining industries. And I just don't know how we're going to go from reshoring developed economies and green revolution and making housing affordable through building more homes all sorts of even defense spending itself, and not making the metals and mining industry, just one example, a lot more relevant than it is currently, and it used to be a lot more relevant. So, that is just one part of the whole all these imbalances that are I think offering great opportunities out there right now. But and you can see that as well from an inefficiency standpoint. I mean, a lot of the businesses, Nick was referring to the changes in commodity price, in commodity relevance right now, and it's really interesting how that works. I think commodities kind of in my view work through a rotation period, and that's when you're in a sort of a commodity cycle. Is you see natural gas becoming popular, or I should say it started really with lumber prices getting popular, then natural gas, then turns into oil, then ammonia prices have a run, then agricultural commodities have a run, and people get caught up on, oh, lumber prices are down now, but hey, maybe that's the next one to start moving again, right? Because that's how they rotate. I mean, nat gas is starting to have a move again after being down for drastically over the last months or so, and that's how that kind of works. And uranium now is hot, and orange juice is hot, and but there are other commodities that haven't really moved yet, and gold is close to a triple top, and now potentially could be breaking out of that and changing the whole game, and then silver starts moving. And so I pay close attention to things that are in this rotation period that have not really moved in a while, and I still very compelling supply and demand cases for it. And I'm not bearish on any commodity, by the way, but I do think that there's pockets that look even more attractive from a demand and supply perspective. And so this is sort of the way I've been approaching this.
I've been a commodity investor for over 15 years, and I'm the host of one of the world's largest commodity investment conferences. I teach a 10-chapter course on commodity investing for beginners. No complex strategies, just actionable information. Our comprehensive course breaks down the complexities so you can make informed decisions and gain financial freedom. I'm Jay Martin, and this is the Commodity University.
I appreciate that. And, you hit at the beginning there how starved of capital some of these hard commodity sectors have become, and how do we get towards any sort of renewable energy future without financing the ingredients of that renewable energy technology. And one shift that I've kind of been waiting for, and it's happening now, is, I don't know, have you guys been following the KoBold story out of the Silicon Valley? So it's a little bit, they're like a, AI platform that's mission is to create a Google Maps of the Earth's crust. But the way they intend on doing this is by essentially making the exploration business more efficient, less capital intensive, more expeditious in determining where to explore versus where to move on from, and notable because there's some big money behind it. Obviously, the funders and founders are like Jeff Bezos and Jack Ma and Bill Gates and Richard Branson, but they're allocating, like they're writing checks, big checks, into mainly like copper right now, and they're looking at cobalt companies. But as I understand their mission, they have no interest in becoming a mining company, but they have a big interest in expediting the extraction of key minerals and making the whole exploration business more cost efficient, which I'm really curious to see if that works. Now, their model's not really proven, I'd say. They're allocating cash. They've got the tech track record to say they can often build the systems they claim to. We've got to see results, right? But are either of you following that story at all?
I've seen the KoBold, and I've seen the money that was put into it, and have been involved in a couple of junior exploration companies that have land that's either been, staked adjacent to KoBold holdings, or KoBold has come in and staked around some of these, junior miners that I follow. So I've seen it in that way. It's funny because obviously, from my seat looking at junior mining deals and such, I see how they're promoted, and it's certainly become part of the lexicon now to say, KoBold has done, run AI on this area and has decided to stake here. So that's as much as I've gone into it. But what I will say is you're going to see all sorts of stuff like this pop up, right, as we try to solve this challenge over the next 15 to 20 years. I mean, you've seen companies like Goldspot already use AI to come in and try to help, show companies where to drill or and where to step out, et cetera. And so certainly as technology develops, we're going to continue to do that. And I guess, back to Tavi's answer about the cyclicality is, and to your point too, Jay, is, prices will tell the market when it's time to solve these shortages. It's like, copper at 350, it's telling me it's, maybe it's not as urgent as some people have said. When copper goes to $5 or $7, I bet you see projects coming online more expeditiously, and governments starting to permit them a bit faster. And I think, commodities are, I don't know if they're a victim, but they're cyclical, and they're cyclical both in the short term and the long term. And I think this is partially what Tavi was saying. So in the long term, I believe we're in a commodity super cycle. In the short term, I think we're in sort of a late stage economic cycle, and we've got to sort of deal with this slowing growth before we can get back to the rising growth across the board in commodities. And then, yes, commodities encompass a basket of different things, hards and softs, and things that grow and things that have to be mined. And they do go around in different cycles, and it's important to pay attention to those. And it's important to pay attention to the overall cycle as well. So last thing I would say, I guess, on the commodity cycles is, the last one started in 1994, and it ran hard for a couple of years, but came all the way back to its base in 1999 when the dot-com era crashed. I think this super cycle started in 2020, and if you add 5 years to that, it could be 2025, and you get a retracement back to the mean before it takes off back again in earnest. It can't defy the short nor the long-term cycle, I guess, is what I'm saying. And right now we're dealing with a bit of short-term turbulence on what I otherwise expect to be a pretty smooth 15-year flight.
Well, that's really important, because we tend to get distracted by near-term headlines and volatility that pulls us away from our big picture outlook. And if you're a long-term value investor, in theory, right, you should be able to sit back and watch the near-term volatility, check in on your long-term thesis and say, has the big picture changed? No, maybe something got overbought or oversold. Nothing goes up or down in a straight line. But, I find a lot of peace, like stepping back from the noise and saying, what do I think the world's going to look like in 10 years? Right. Mm-hmm. And that gives me a bit of perspective on how to stomach near-term volatility. And, another thing that you mentioned, just back on the KoBold, you expect a lot more stories like this to come out in the future. And I think you got to be right. It was striking. I had Ross Beatty on my stage at the January event, my VRIC conference last January. And he outright said, he's like, look, Jay, we don't have a shortage of copper. We have more than enough copper. Problem is, it's beneath the surface, right? That's the issue, right? So if you think about it like that, yes, it's a supply and demand issue because we don't have it, sure. But it's also an innovation issue more than it is a supply issue, right? We need to get more efficient, more capital efficiency at extracting these. But okay, I want to pivot now to where you're allocating cash. We've I'll stick with you, Nick, here. Based on your interpretation of the world, the market right now, where are you putting your money?
Yeah, a lot of cash, probably around a third cash. And I divide my buckets into, more speculative and then, safer or longer term cash. And on the longer term cash, probably around 30%. In money markets, you can get 5.25%, and you buy it for one and you sell it for one with no sort of capital risk. I think a lot of people are doing the same. So cash is my largest position. I've been buying gold on dips. I think gold is bullish, especially after holding the most, the recent pullback there down to 1810. So gold itself, I'm talking about the gold, either physical or like GLD or something like that. On pullbacks have been adding. For private deals, I haven't written a lot of checks. I think I've only written one check since right after VRIC, in fact, as tends to happen. I wrote a couple of checks in February, and then since then I've only written one, and that was into a private lithium deal. So, and I'm sure you've noticed in your talks, both of you guys, that companies are delaying going private. We're waiting for better markets or whatever. We're waiting for a window, and so some of these private deals can't go down if they're not public. And one came to me recently from a pretty well-known mining and royalty group that had some lithium land in Quebec. So I wrote a check into that. And other than that, I think those would be the top three things I put in a decent chunk of capital into lately: cash, actual gold, and quality lithium stocks. Private.
I love that. And I sometimes people shit on holding cash. It's so undervalued, and gives you the optionality to strike, the opportunity to be brave when people are running away. Okay, so Nick, the audience is going to kill me if I don't ask you for some companies you're paying attention to right now. any publicly listed resource companies that you think the audience would be smart to take a peek at?
Yeah, I'll give you also the caveats and the timeframes and all that. So I think Headwater Gold is one worth paying attention to. This is a very early stage gold exploration story. I said I like gold. I also like companies that are financed, right? That don't have to finance in this environment. And Headwater is one of them. Has raised money, has a deal with Newcrest that's earning in on 4 of their projects, and probably have one of the largest drill campaigns this summer fall of a junior drilling something like I think 25,000 meters, mostly in Nevada and a bit in Oregon. So lots of shots on goal funded by other people's money, which I like to see, and in that sense, a bit of a hybrid prospect generator and self-explorer. So Headwater Gold is a decent speculation, I would say, but it's still high risk. This is early stage gold drilling, of course. And then we mentioned uranium. I guess I'll give you a uranium one that I've held for a long time, and that's Sky Harbor Resources. I participated in multiple private placements with this company, I think going back to 2016 or 2017. And at this point, they've got a pretty dominant land position in the Athabasca Basin for a junior company. And same thing, spending lots of other people's money with earn-ins, I think, on something like 9 or 10 of their projects with other companies in the basin. And then, of course, they have some assets that they explore on their own. So 1 gold and 1 uranium there, both pretty early stage. And a shareholder of both.
Appreciate that, Nick. Appreciate that. Yeah, I mean, uranium investors are finally getting some liquidity. It's been a long road. And Jordan Trimble, the CEO of Sky Harbor, I mean, guy's been dedicated to that story and hasn't wavered. That's been a tough boulder to push uphill, right, for the last decade. As you mentioned, you've been in the story since 2016. Been a couple of breaks here and there, but they're finally getting some movement and sentiment shifted. A lot of action in the Athabasca right now. Okay, thank you for that. Tavi, over to you. Where are you putting cash right now, based on how you're interpreting the world?
Well, I'm firmly believe we're very close to a breakout in gold. If that's the case, I think valuation of companies that have gold in the ground or potential gold in the ground are extremely cheap right now. And so it's been most of our focus. And if you're dealing with, building small companies, with, very minimal amount of capital, the gold space is a great place to start when it comes to exploration, just because how much cheaper it is to explore in the gold space relative to copper and other commodities. So it's been sort of, at least my main focus has been in that right now. But majority of, I would say, institutions love to invest in distressed opportunities. And boy, is there anything more distressed than mining I can think of? So, I've been, my own personal capital has been actually put into a few private deals in the silver space. Which it's not going to help you much here with this audience. Brazil is a market public that I'm very focused on. I've been buying the dip in Brazilian companies, Brazilian banks, is one of my main focuses, and majority of that outside of commodity businesses there has to do with the fact that those companies are businesses that have pricing power, but not only that, they've been established for over 30 years and are trading at historical low valuations. And so I've seen this movie before, and so I'm just starting to deploy capital into that market in a significant way. And we'll note it how well Brazil has been doing, despite the fact that we've seen the steepest rate hike cycle in many decades. And so it's quite impressive how those assets have been performing. So yeah, those are. I'm not sure if you want individual name of companies. Happy to share some, but those are sort of where my focus currently is.
Well, since you're offering, Tavi, yes.
I have a few. Well, personally, will be investing in Altamira gold. That's in Brazil as well. It's in Pará. They have some great assets, a very similar geology style from Snowline Gold. For those who don't know, we were pre-IPO investors and probably the largest investor pre-IPO in Snowline Gold. So we've been certainly looking for stories of that are similar geology, and that's one that comes to attention. The second one is Tectonic Metals. That certainly is in the list of those that fall into the same category, but also will be already drilling this season. So we're really looking forward to that. And those are all early stage companies, high risk. So be aware of that. Other one that is surprising. I mean, I think there's a few companies in our portfolio that have already hit, what we call discovery holes, and they are trading below those levels. And so, I think it's a great opportunity right now to be accumulating some of those shares. So in my opinion, some of those are Western Alaska is one of them. And the second would be Kuya Silver as well. They have a great discovery in Ontario as well, along with an asset in Peru. Western Alaska is in Alaska, and really high grade discovery too in Alaska. And the other one that I would point out that I think it's quite interesting because of what's happening in terms of the development of the story is Barksdale. No, they just got their approval. They're drilling. They've got they got an incredible historical deposit of best part of we think of the Taylor deposit owned by South 32, and so now they're drilling the project, and so we're really excited about that one. And it's surprising the stock has been selling off recently, so maybe just created a liquidity event for some folks, and they're moving on. But I think we're on to something very special for the long term. So we're committed to those stores.
Okay. I love that. Thank you both. Appreciate your time. You're both going to be in Vancouver in January at my conference. So I'm looking forward to that, getting you both up on stage and chatting further. Anybody who wants to catch more of either of these two gentlemen, Vancouver in January is one place you can do it. But outside of that, where can people find you? Tavi, I'll stick with you. People who want to learn more about your business and what you're up to, where can they go?
You can find me on Twitter at Tavi Costa, or you can find the business that we run is Crescat Capital. So crescat.net is our website. If you look for macro research, and if you want to know more about funds and so forth, you can find all that information in the website.
Appreciate that, Tavi. Nick, how about you? Where can people find you?
dailyprofitcycle.com is the easiest place for the one-stop shop to look at paid publications, the podcast that comes out every Tuesday that I do with my partner Gerardo, and also for the free e-letter of the same name there, Daily Profit Cycle.
dailyprofitcycle.com. All right. Look, I appreciate both of your time. I'm looking forward to hosting you in Vancouver at the VRIC very soon. Thanks so much.
Appreciate it, Jay. Thank you.
Thanks for having us.